So the next session, ladies and gentlemen, is a fireside chat focused on the future. And I'd like to invite the moderator for this session to join him for this fireside chat. I hope that we are still in high spirits and still generous with our applause as I welcome to the stage Mr. Tage Kene-Okafor, a tech journalist at TechCrunch.
Hello, everyone. Good morning. Good morning now.
Good morning.
Good morning. So I'm Tage Kene-Okafor, African journalist for TechCrunch. Nice to be here, and thanks for having me. With me, he doesn't need any introduction, but we have E here, so we can give him a round of applause, please. All right. So today, our first, panel discussion of Fireside Chat is, how did we get here? A perspective on the market, the macros, and launching an accelerator. So, first question. We heard your speech and why or how Accelerate Africa came to be, but can we get a bit more perspective on the why? First of all,
Absolutely.
So like a backstory of starting Accelerate Africa.
Yes. So everybody that knows me knows I've always said the YC of Africa is YC. That is sort of my standard line. Whenever anybody tells me, oh, I'm going to an accelerator, I said, look, don't waste your time. The YC of Africa is YC. Let me spend time helping you prepare your pitch, and then you can go to YC. Because ultimately, the job of an accelerator is to accelerate you, and they're only going to be able to do it in a couple of ways. The most popular way is to give you access to investors. YC, Techstars, you're sitting in front of thousands of investors, and that's what makes sense, right? Even if you don't get anything else from the experience, you do have access to those investors. Unfortunately, times have changed, in good and bad ways. In good ways, the ecosystem has matured, and very different from when we started going to YC in 2015. I think the local investment ecosystem has truly matured, and there's a lot more local investors than we used to have. But also, on the other hand, the end of a zero interest rate environment has meant that quite a number of investors have pulled back to yield models and investment targets that they fully understand. And that means that investing in Africa might be a bit too exotic. And so what that has meant for us is, well, we have two options as a community. Option number one is to imagine that, well, this is what has happened, and we're going to throw up our sleeves and go beg everybody else. That has been done before, right? And hope that the DFIs and the philanthropists come and fill in the void. Or maybe this time we can actually take a bold step of faith on our own and build our own capital stack. And I think that's what this is about. It starts with a pipeline of incredible companies that the ecosystem has access to. And then it builds up from there. And I can say this confidently because I was there when YC was getting built in 2007, 2008. I actually watched it happen. I was in Silicon Valley. I was in my second year of school, but I was in Silicon Valley at the time, spending my holidays there, and I watched them build from a dinner table in Paul Graham's house with a few startups. I remember I had a friend of mine, Eric Mikogovsky, who was in the Velocity residence, go to Silicon Valley. He ended up building Pebble, which at the time was this incredible Apple Watch before its time. And I watched them build and grow and become what they are today. And I think to myself, it's possible for us to do it here. There's no reason why we can't.
All right, that makes a lot of sense. However, thinking about the current macro conditions affecting startups and venture capital, and we know all these things happen in cycles, right? So there's a bull run, there's, a downturn, it goes up and down. And we've seen retreat from US investors, from, excuse me, from European investors, right, from foreign investors in general. And what if they were to come back? Say, for instance, interest rates are good, and all of a sudden there's a newfound interest in African startups. How will Accelerate Africa compete? Because think about it this way, YC has raised a lot of money, right? Yeah. Techstars, the same thing. And, Accelerate is with the grant, about 700 or so.
Yeah, with nothing, literally.
So, what should founders optimize for is what's Accelerate Africa providing to them enough to withstand a comeback from YC and Techstars?
That's a great question. We're a very different kind of accelerator. So, for example, we don't offer any investment deal like YC does. That might change in the future, but right now we don't. It's actually an equity-free accelerator, which also means that we don't invest until after. We're actually leaning on those of you in the audience here and elsewhere to do the investing. So we're not competing on funding. So the fact that we have spent very little money comparative to YC and Techstars is not going to be our competitive advantage to startups. If you're looking for somebody who can give you money, maybe Accelerate Africa will not be the most competitive offer that you have. However, what we're really good at is our ability to bring together the local community in the market where we've spent a decade operating and put you on a ramp to $1 million in revenue. I don't think anybody can do it better than we can. And somehow, I feel like even in a post-interest rate environment, global investors will value that. They would value the guy who can get the CEO of Sterling Bank to have a conversation with you. They'll value the person who can get some of our trusted advisors to have conversations with you. I think that startups in this environment understand that funding will come and go, but revenue remains forever. So I think they want to build more sustainable businesses, and maybe not all of them, but the ones that we definitely want to work with are the ones who do. And we think that that will put us a little bit above those whose primary competitive advantage is their ability to deploy capital to you.
Okay, but the end game of VC, for instance, is to make returns, right? Probably to exit or to go public. And somehow we've all been accustomed to the Silicon Valley style of doing things where, there's pre-seed, seed, Series A, and investors keep pumping money, right? While other investors, add to the stock. That means funding is important. You invite, say, local HNIs or, institutions, right, to actually back the startups, because there is not a lot of that going on for, African startups or Nigerian startups at the moment.
Precisely. I mean, you literally read my mind. That's the vision. The vision is that we want to be the accelerator that prioritizes local capital over Silicon Valley capital, which means that we have a tight partnership with the local corporates. It means, and many of them are going to be here later today, these are some of our partners. As the startups will tell you, during the program, we had a lot of these large companies show up at our tiny apartment in Yaba for fireside chats. We have many of these companies, many of these, their top people providing advice to our startups. We're working actively with them to build exit paths and solve problems that they actually have, not problems that Silicon Valley has. But I think more interestingly, the market is going to change in a significant way in one respect. This is a prediction. And I think that, the raising rounds forever model, I think will become trite, and a lot of founders will have PTSD from being left at the altar in this time. And they're going to ask themselves, do I want to build a business that's sustainable, or do I want to build a business where I'm literally at the mercy of the funding environment. And I think many of them will choose the former. And what that would look like is companies get significant funding between now and Series A. And at Series A, they have a decision to make. Am I going to get in bed with a global VC, right, who has the power and the ability to fund me irrespective of market trends and conditions? Or might I as well just go public in my local markets, build a very profitable business, and grow organically over a period of time? And I think that's going to be the big divide. And I think something that would accentuate that divide is that you've got a lot of investors in Africa who, on the back of the last boom, have now raised about $1 billion in capital. But they're waiting for startups at Series A. And they're going to be forced 3 years from now to deploy that capital. And that's when the madness starts. And you're literally going to have founders that are smart be able to choose, because they've built sustainable businesses that are growing very fast, between these three options, and force them to compete. Where I say to myself, well, if I can't get, my baseline is the stock market. If I go on the stock market, Nigerian pension funds have 16 trillion naira that they're looking to deploy. That money is right there sitting down looking for yield. Then you're going to have the African VCs who have $1 billion to deploy and are looking also for companies that have scale and profits and all of that. And then you're going to have the global behemoths who are looking for even better performing companies and are looking again for good performers, financially strong, etc. So if you're a startup founder today, what you want to optimize for is building a fast-growing, profitable business above everything else. Because painful as it might sound today, it's the choice that gives you the most options at the end of the day.
Okay, so you mentioned, startups going public, right, in local markets, but we've not seen enough precedents for that to believe that it will happen, right? So we have InterSwitch, we have Flutterwave that have stayed long, like being private for 6 to 10 years, and they're weighing options of, okay, either listing in Nigeria or listing in the US. So, should founders feel pressure to, list in local markets when they can stay private by accepting foreign capital?
Well, the question is, where is the foreign capital? Is it truly there? Because if the foreign capital isn't there, then you have no choice but to find a way to release valve on liquidity. And the only way to do that is through local stock markets where the pension funds are waiting. You're right, we haven't seen a big listing, but we've seen evidence that the market is hungry for technology products. I mean, you look at an MTN become $1 trillion company literally overnight. You look at Chams being valued at 22, like startup multiples, even though they've been around for 25 years. The market is literally screaming for anything that is like even slightly digital and makes just enough profit to pay them dividends. So I think that entire thing is going to change. Also, if you look at other markets like India in particular, you can already see the huge shift to tech and technology-driven companies and products. So I think there's no question that that's going to happen here.
So how do startups, because now VCs are saying they should stay profitable longer, they should stay profitable or try to stay alive, and also there is the other set of VCs that are actually optimizing, wanting startups to optimize for growth. So how do they balance this in a way that they remain attractive to investors that want growth versus profitability, which is important for their own survival?
I think there's a thin line between those two philosophies, which I call profitable growth. And that means that you have to pay particular attention to your unit economics as a startup. And that typically means that, in Africa, we know that retail is a very expensive way to grow. And I think that what's going to happen is a lot more startups are going to see the wisdom of partnering with corporates who are also hungry for profitable growth. It's their lifestyle, right? And you're going to see a lot more close partnerships as a result of that need for profitable growth. And that will be what makes accelerators like us extremely helpful, because we can make those types of partnership happen. Maybe later on when the companies are talking, they all have interesting stories of, showing up to accelerator without a partnership, without a credible path to $1 million in revenue. And many of them are leaving the accelerator today with very, very credible paths to $1 million in revenue. And I think that's why we want to focus there, because we think that's really the secret unlock. How can we reduce your cost of acquiring users by giving you the ability to partner with a big platform while enabling you to grow profitably over the long term?
All right. And how would you say the current macros will affect, startups from Accelerate Africa, in the sense that we've seen, FDIs leaving the country due to what's happening, right? And we have lower spending power as a people, and everything's, not going according to plan for startups, right? In the sense that they raise money in dollars and the revenues in naira are depleting. So what kind of, and the partnerships with the corporates are also being affected, right, by the current macros. So it's a zero-sum game, right? And it's, I think personally, how, as a startup founder, right, how do I grow in such an environment where, I don't have access to enough funding, but I'm leveraging the expertise of the corporates, partnering with them, right? But at the same time, the market I'm targeting isn't attractive enough at the moment.
I think one big misconception we've inherited over the last few years is this belief that investments are what deliver value. And the truth is, that's not how it works. In actual fact, value is what delivers the investment. And so when FDI is leaving, that's really good news for startups.
Really?
Yeah, because what it means is that the FDI is leaving and creating a gap where you can provide value, which then attracts the capital back.
But they are leaving for a reason, right? And, as a startup, trying to fill in those boots when you have less money to scale or spend to acquire customers, isn't that harmful to them?
Well, you don't need money to acquire customers. You need value to acquire customers. And I'll tell you, my own personal story has been every time the market said FDI is leaving has been exactly when we started the companies that have become the household names today. People just catch on 3 years later, and I'm happy to wait for them. In 2014, we started Andela literally in the middle of Ebola, and inspired by a stampede that happened in a stadium where 60,000 young people showed up to be employed into immigration service, and a few of them died because there was a stampede. That was literally when we started. So if you think about the perfect picture of FDI, that was not the picture. When we started Flutterwave at the time when the Buhari government said banks have to now hand over all government deposits to the central bank, right? And literally, a ton of money was leaving the banking sector. That was when we started Flutterwave. Now, you know the secret. Those banks and those employees were only willing to talk to us because they needed value. There was no more fat to cushion the realities of a market. And that's how it feels right now. There's no exchange rate fat. There's no energy fat with subsidies. There's no food inflation fat with palliatives. You know what I mean? Now everything is about value. It's value for value. And even as corporations feel the pinch, if somebody is able to deliver value to them, that person, no matter who you are, now it doesn't matter whose father you are, now it doesn't matter, because they can't afford anymore to deal on the basis of what they're used to, which is relationships and nepotism and all that. Now it's about, are you going to deliver the value or not? Because it doesn't matter who you are. If I can get more profit by working with you, you're welcome to get the contract. And that's how we have to think. This is an incredible time for investors. And I think when the FDI comes back, they would pay us for taking risk. That's what I'm looking forward to. I want that $1 billion that's sitting at Series A, that's my exit. It's right there waiting for me. And I just need a few of these companies to scale to the point where, undeniably, that $1 billion will come in to foil their businesses one way or the other, and will give us an opportunity, and investors in this room who invest, an opportunity to get their exits.
All right, thanks for that. One more question. So in the past, we've seen, CC Hub, Accelerator, Idea Hub, and all that. And for me, when I think about like the biggest names, right, in like the biggest startups, right, in Nigeria and Africa, most of them didn't launch from accelerators, right? Bar, Flutterwave, for instance, or Paystack from YC, right? You have, other companies like, Jumia, Andela, Yoko, and all that. Fair Money, Koda, and the likes. They didn't launch from accelerators, right? So my question is, do startups really in this climb really need accelerators? Unlike in the US or Europe, where we've seen accelerators play a big part in launching those companies?
Well, this very quickly. This was one of our biggest worries in starting an accelerator. And I say it often that we did not want to do an accelerator because we felt that there was a real...
Excellent. A round of applause for E, please. I hope that was insightful enough for us. Do we have time for questions? No? Wow. Okay.
Thank you.
Thank you.